What is going on with Alibaba? Today, Baba dropped their earnings report and the market reaction has been interesting. The stock was up 4 to 5% pre-market, but right after the market opened, the stock is down 2%. What happened? On this channel, we don't just read the headlines, we dig into the fundamentals, we look at valuation, we try to find those mismatch opportunities where the market sees fear, but we see value. In this video, I'm going to break down exactly what happened, the good, the bad and the genuinely shocking numbers regarding their free cash flow. We need to answer one question: is this the turnaround we have been waiting for, or is the thesis broken? If you want to find undervalued stocks and actually understand the story behind the numbers, make sure you smash the like button and subscribe to the channel. Let's dive into the numbers. If I had to summarize this quarter in one phrase, it would be the heavy investment phase. For the last year or two, the narrative around Alibaba has been cost optimization, cutting fat, improving margins and generating cash. That narrative is officially dead. The story has shifted. Alibaba is now aggressively spending to defend its market share in China and, more importantly, to capture the massive AI boom in the cloud sector. Top-line revenue is growing. We saw a 5% increase year over year, but excluding the impact of the sale of some division, revenue grew 15% year over year. That's very good. However, the cost of that growth was huge. Profitability has taken a significant hit this quarter. Management is making a very clear bet. They are sacrificing today's profits to build tomorrow's infrastructure. They are pouring cash into AI servers and logistics for quick commerce. The question we have to answer today is this a smart strategic pivot, or are they burning cash just to stay relevant? Let's get into the nitty-gritty, starting with the absolute star of this report, cloud intelligence. This is the bullish part of the thesis. Cloud revenue surged 34% year over year to 39.8 billion RMB. This isn't just slow, steady growth anymore. This is acceleration from 26% last quarter. And it's being driven entirely by the public cloud and AI-related products. In fact, AI-related product revenue saw triple-digit growth for the 9th consecutive quarter. They are clearly capturing the demand for AI compute. But here is the best part. Unlike the rest of the business, cloud profitability actually improved. Adjusted EBITA for cloud increased 35%. This tells us that their bet on AI is starting to yield better margins. It's scaling. Now, let's look at the core e-commerce business in China. This is where things look good but could get complicated. Revenue grew by 16%, which sounds great for a mature business and a huge part of their revenue. A huge driver here was the quick commerce segment. Think instant delivery, which exploded by 60% thanks to the rollout of Taobao instant commerce. But, and this is a massive but, achieving this growth was incredibly expensive. To get that revenue bump, Alibaba sacrificed a massive amount of profitability. The adjusted EBITDA for the China e-commerce segment collapsed by 76%. Why? Because they are spending heavily on user experience and logistics to compete with guys like Meituan and Douyin. They are growing the top line, but the bottom line is bleeding to make it happen. Okay, we have covered the growth. Now we need to look at the critical points that might be scaring Wall Street today. These are the numbers you really need to understand as a shareholder. First, the shocking drop in profitability. The adjusted EBITDA for the entire group fell 78% year over year. Make no mistake, this isn't a revenue problem. People are still buying things on Alibaba. This is a spending choice. Management explicitly stated they are investing profits. Your job as an investor is to assess trust. Do you trust management capital allocation? Are these investments in quick commerce absolutely necessary to survive, or are they burning cash inefficiently? That is the multi-billion-dollar question. Second, and this is rare for Alibaba, negative free cash flow. Free cash flow swung to a negative 21.8 renminbi outflow. Alibaba has historically been a cash generating machine. That's why we value investors like it. Seeing a quarter of negative free cash flow is jarring. The cause? It's the sheer scale of their capital expenditure cycle. They are buying AI servers, building data centers, and funding inventory for quick commerce. They are spending their war chest. Finally, point number 3, margin compression. The operating margin dropped from 15% last year to just 2% this quarter. That is razor thin. When margins are that low, you have very little room for error. If revenue growth stalls, even a little bit, while spending remains high, you start losing money. The safety margins on the income statement has temporarily evaporated. The good news is that Alibaba has a fortress of a balance sheet. So, where does this leave us? It is my honest opinion on this report. I can see a bull case. This is a courageous pivot quarter. It takes guts for management to kill their short-term profits to secure the future. They have correctly identified that cloud plus AI is the future engine of this company. And the fact that they grew cloud revenue by 34% proves they are capturing that opportunity. Also, a side note we didn't touch on much. The international business finally turned profitable. That proves they can fix bleeding segments. If they can do the same thing for the China commerce investments, Alibaba could emerge significantly stronger and more dominant in AI infrastructure than they were 5 years ago. However, it is my verdict. This report requires extreme patience. This is not a harvest quarter where we sit back and collect dividends and buybacks. This is a planting quarter. If you are a long-term investor like me, you probably welcome the success in cloud and AI. But you need to be wary. We don't know how many more quarters of this investment phase are ahead of us. That means low profits, high spend and ugly cash flow could be the next new normal for 2025 and part of 2026 before the core China commerce business stabilizes its margins. I'm holding my shares because I believe in the AI transition, but I'm watching those margins like a hawk next quarter. But I want to hear from you. Are you buying this dip or did the negative cash flow scare you out of the stock? Do you trust management's pivot? Let me know in the comments below. If you found value in this deep dive, please hit that subscribe button so you don't miss our next analysis. Thanks for watching and I'll see you in the next video. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.